Everyone. My name is David Jarvis. I'm the president and CEO of Corton Capital. I'm here with Mark Derritt from Cormark Securities. We're here to talk to you about the returns of the Cormark-Corton Quantitative Opportunities Fund for the month of June. And without further ado, I'd like to turn it over to Mark Derriott, who's going to begin with some opening comments and some statements with respect to disclosure requirements. Mark, over to you.
All right, thanks a lot, David. I will do a brief market overview that I think is one of the value adds, perhaps, of our product, is that I've been a quant technical analyst for over 20 years on the sell side at Cormark, so I'll go through the market views. I guess most importantly, from a compliance perspective, I have to read this disclosure before we start. I'm an officer and director of Cormark Quantitative Analysis, Inc. That is a wholly owned sub of Cormark Securities. And CQA developed these quantitative models that have been licensed to and implemented by Corton Capital. Corton is the investment fund manager and PM of the Cormark-Corton Quantitative Opportunities Fund and its underlying fund, the LP. Each is a related issuer of CSI and Corton. So let's get on with the show. So as you can tell from the title, we're quite constructive on the market. We see upside for the S&P towards 67 and then 7,000. We'll show you how we get there from a technical perspective. And most importantly to us, we look at a lot of breadth measures, and they're only around neutral after hitting extreme lows in the early April. So there's more fuel in the tank for breadth to expand and drive this market higher. So we're technicians and we do quants as well, kind of wear two hats. And so when we're looking at the S&P and when you're in new high ground, we look for what they call Fibonacci extensions, and these are these horizontal lines that I've drawn on the chart. So taking this base and extending it up, we get 6,700 and then roughly 7,000 as upside objectives for the S&P. And if we zoom way out, we always like to start with the fact that we're in a secular bull market for stocks. It started in 2013. These historically have lasted around 20 years, and the CAGR during these periods is 13% versus when you're in a bear, you're effectively going sideways, and the CAGR is just 3%. So we think this should last to, call it the 2030 to 2035 period. And one of the fundamental drivers of this secular bull is the fact that millennials are entering their prime workforce age, and that's from 25 to 54 years when people buy a house and get a real job and so on, have families. So that's not expected to peak until 2035. So these demographic trends are baked in the cake already. And we note that the prior bull market from 1980 to 2000, the boomers were the drivers of that. And the cohort that prime workforce age peaked in 2000, right in line with the peak in the market back then. We've been talking about our research since early April that we saw extreme bearishness and blood in the street. So we've got this 10-step checklist for a bottom. And now we've thankfully ticked a lot of them off, and we're in this later stages, 7 through 9, where we see improving risk appetite, rotation into cyclicals, and the culprits of the bear stage a rally, which we'll talk about. Semis have been the culprits this time around. So we thought we'd go and update these indicators for you because they're still suggesting that there's more upside to come for the market. So the first one is simply a sentiment indicator measuring the percentage of bulls out there relative to bears. And in early April, it got to real extremes, even worse than the great financial crisis, believe it or not. This got to the lowest level on record, tying the 1990 level. And importantly, there's still actually more bears than bulls, which is surprising given this quick snapback of the market. So we don't see extremes the other way in sentiment that would get us concerned. And then step number two is what we call blood in the streets. There's simply a lot of stocks that have undergone a bear market. So the red bars here show the percent of stocks in the Russell 3000, so a very broad list of companies um, that that have hit 52-week lows. And that got to extremes in early April. And you can see historically when that hits extremes, that's a good time to buy. For instance, mid 22 and the COVID lows in March of 2020. And we're only at 4% new highs. That can expand further. Usually that green bar gets to north of 20% before the market starts to peter out. And then another simple way we look at this is the percent of stocks above their 200-day moving average, just to define an uptrend or a downtrend. That got to 12% in early April. We use below 15% as a cutoff. And other than this period in 2008, Jan '08 through March of '09, it's been a good time to buy historically. We back tested this, and if you just blindly buy when the indicator gets below 15%, the historic returns are in red versus the S&P in gray. Looking 12 months out, for instance, you're up 20% on average. These are the actual stats. And again, nothing works perfectly. In Jan '08, that was a bad signal, but it's got a quite high hit rate, you can see. Step number three is what we say buyers step into the market. So we look at what they call 90% up days. More than 90% of the stocks are up and 90% of the volume is up volume. We saw that first trigger on April the 9th, just after the actual low. And we overlay these green bars, these 90% up days historically with the S&P, and you can see they tend to cluster around major bottoms as well. And April 9th was a very unique day. If we look at the daily returns and really big up days, 9.5% represents an 8 standard deviation event historically. So these are all the +4 standard deviation events since 1980. You can see there's only been about 20 of them. And importantly, that tends to happen, these really big up days, after you've seen this blood in the streets. So the red bars show that same percent of stocks making 52-week lows, hitting extremes. And then very shortly after, the green bars show the really big up days in the market. So we know that the maximum pain is over. Step number four, we either get a retest or a V bottom in the market. This is the world ex-US, and clearly it had a quick V. The S&P took longer to get to the highs, but the world ex-US kind of led the way out. The S&P, this is a bit of a busy chart, but now it's also joined the party and made all-time highs. So we see the V bottom here, and then more similar to COVID. 2022 was a more drawn out bear market where you had rallies that failed below their moving averages. So once the S&P was able to recapture its moving averages, that was a bit of a clue that maybe we don't get a retest of the lows. Historically, V bottoms only occur about 30% of the time. So typically, you have this blood in the streets, a lot of stocks making new lows. The market has a rally and then retests, often making a slightly lower low. So you have historically more time to sort out the winners and losers of the next bull market. But this one was a very quick V. We launched the fund in the midst of this V bottom, by the way. So these are the historic data that comes into this play for this chart. I didn't describe this, sorry. The x-axis is the number of months from the peak to the trough. The y-axis is the number of months from the trough to 52-week highs. And you can see these red bubbles, and the green is the recent V bottom. So then step number five, we get a lot of stocks turning up at once. This is what happens at a major low. And one way to measure that is simply how many stocks are making 4-week highs. And when that exceeds 50%, that's the trigger, and that happened in mid-May. And we back tested that as well, and the historic returns are 16% over the next 12 months with a 97% hit rate. And then we get what we call the dust settles for step number 6. So once the VIX gets above 45, that means people are spending a lot on insurance. There's a lot of volatility out there. And that's the setup. And then we look for the 10-week rate of change of the VIX to get back below zero. And that's when the dust settles. It only took 1.3 months. And historically, it takes 2.5 months for that to happen. So it's a very quick snapback. Step number 7, which we've started now, is improving risk appetite. So we have what we call a baker's dozen of risk trades across broad financial markets that are delineated in the box on the left. You can see it's snapped back really quickly here. So risk appetite is improving. One of the key things we watch is the credit market. The red line here is credit spreads, but inverted. And typically they give a heads up at a top. The S&P is the blue line. Credit usually deteriorates ahead of the top. This time it did not. They kind of both jumped off the cliff together. And now credit spreads are tightening again. So this is inverted, this red line. So the credit market is recovering in line with the equity market. And then a rotation sectorally into cyclicals is happening. So this is a basket of industrials, tech, and discretionary in the numerator versus defensive, staples, healthcare, and Utes in the denominator. And that has just made 52-week highs. So we're seeing this big rotation into cyclicality. So here we have on the x-axis a long-term momentum measure, and on the y-axis a short-term measure. So the idea is you embrace strength in the upper right, fear weakness in the lower left, and you tend to rotate clockwise. So I've just circled the cyclical areas of the market that are showing improvement versus defense that's in the rain in general, and weakening, such as utilities. Our bottom-up momentum models that we publish in our research every day is leaning towards cyclicality as well. So in the S&P, we look at the top 100 names. We're big overweight technology, industrials, and financials. And for the TSX, we've got big overweights in financials, notably golds. And at the bottom of the list is a lot of defense, REITs, telcos, pipelines, utilities. We also look at factors. So this is another step in our checklist. And beta tends to outperform, not surprising when we're in gear with the markets. And we see here a ratio of high beta to low vol. The momentum of that ratio got as low as it did during the COVID bottom. So this is the setup, and then you wait for that momentum to turn. Now, there's no way of knowing that we've had such a huge snapback. That's pretty rare, but that continues in favor of beta. Step number 9 is what we call the culprits of the bear staging a rally. So we have a table here historically. There's been a strong theme in the market, and then it tends to peter out ahead of the S&P on average 6 months. So semis were the culprits of this bear. They peaked out 7 months ahead of the S&P. Now they're staging a big rally, which is a step number 9. You may recall the last bear market, speculative growth stocks were the culprits then. So here we have in red the ARK Innovation ETF. This Kathy Wood is the manager here. And then black is the S&P. So we can see that that peaked out in Feb of 21, 10 months ahead of the S&P, and then finally staged a big rally starting in 2023. And as I said, the semis are the big culprits this time. The semis in red peaked out in July, 7 months ahead of the S&P, and now they're starting to outperform in a big way. Step number 10 is improving macro. And there's a lot of mixed signals coming from the macro indicators that we look at. Most importantly is this divergence between how people feel as measured by these surveys in red and black. They would have signaled a recession way back in the middle of 2022. But what people are actually doing, the hard data, is the blue line. And this measures things like gasoline sales, electricity usage, and so on. That's held up very well, not signaling a recession. And another thing we look for a recession is the labor market. The blue line here is a basket of 8 indicators that track the labor market, and it's all normalized. So you can see post-COVID, we got a huge spike in this blue line, very, very tight labor market conditions. Now it's coming off the boil, but not very aggressively, not like COVID, not like the GFC, et cetera. And we're still well above the neutral zero. So no recession yet on that indicator. And then we're just going to skip over a few of these in the interest of time. Canada is a commodity heavy market, as you are aware. The blue line shows a breadth measure of commodities, how many are in a bull trend, and that's starting to perk up. So we've been noting that and increasing exposure there. And we'll talk about industry themes as well. We like these sun rain charts, we call them, and we talk about them all the time and with various indicators. So these are ETFs, industry group ETFs. And in the sunshine are a lot of very high beta areas. That's the ARC funds that we talked about, semiconductors, IAI are brokers, those are market proxies, and so on. So this is pointing to an aggressive stance as well. We do the same thing for the stocks as well. So again, we're looking for kind of fresh money ideas that are percolating and improving coming out of the rain in this upper left quadrant. And you tend to rotate clockwise, and the intent is to catch them here and ride them into the sunshine and hold them until they start to wane. So we see a lot of aggressive stocks in the sun, notably Celestica is one of the highest beta stocks in Canada. It's hugging that sunshine, exhibiting a lot of strength. We do the same thing in the US, and things like NVIDIA are here, AMD, Texas Instruments, the semis quite strong. And then in the sunshine, a lot of the brokers, Goldman Sachs, et cetera, these market proxies. So we thought we'd take a little bit of a detour now and talk about our process a bit. So what we do here is these emojis. If you think about these sort of cycles that every stock goes through, if you think of the emoji as simply the trend of profitability, and we look at simple metrics like return on equity and the trend of ROE, and price momentum, which tends to follow the profitability of a company. So at the bottom here, everyone is thrown in the towel, and the expectations bar of the street is very, very low. And when the cycle turns, you get a positive earnings surprise versus consensus for the first time after many disappointing quarters. And people are, they don't believe it after throwing the towel. And as the business improves, you tend to get a series of these positive surprises as the company continues to beat estimates, and analysts slowly ratchet up that expectations bar until the point where you're at the top, and then analysts are back in love with the stock. The bar is set too high again. You trip over that bar eventually as you enter a downturn, and you get a series of negative surprises. So that's in a nutshell how we look at the world from a quant perspective. We combine simple metrics like the level and trend of ROE, earnings surprise and revisions, price momentum, and also valuation techniques, which tend to work better when you're coming off a low. So these are some screens. It's probably hard to see on this email, but we'll send out the deck as well. These are our quant screens. We call it the stars. They tick all of our boxes. And we thought we'd go through a couple of examples. So Fairfax is an example that's been a strong stock for over 3 years now, and it continues. This is Fairfax on the right relative to the market. So one divided by the other. When the lines are going up, it's outperforming. You can see that's a very long outperformance trend. And the quant overall is number 12 of 664 stocks in our database. Small cap strong stock recently is Badger. And this has just started to turn around after quite a big drawdown. It's number 64 overall. So we look for these quant stars as a starting point for the fund. And then we have also a value sleeve, and this is a way to kind of pick off those turns. So we have valuation models separately, and then we overlay momentum. And this is an example of a value name that's starting to come to life. So Laurentian Bank, relative to the market, started to turn up, and its value score is 2 out of 10. This is the dashed gray line. So it has been cheap for quite a while, but now it's finally showing momentum. So that the models pick that up. This is Laurentian Bank's price to book versus its history, and it's just coming off the lows. It's now 0.52 times price to book. So that is our outlook for the market, and I want to talk just a little bit about the fund. So very early days, obviously. We started to invest on May the 7th, and it was frankly right in the heart of earnings season, and our model is can be quite impacted by potential negative surprises. So the people at Corton and we decided to come out of the gate conservatively rather than potentially stepping on landmines. So we initially took small positions in the stocks that ranked well. And if their quarter turned out, we would add to those. And if not, we would exit them. So we had a big cash drag in the first month of about just over 2%. The next month for June, we were fully invested in general and did reasonably well. For the F class, it was up 3.4%. And one of our key objectives is to have lower volatility, especially downside volatility versus the market. So here we're measuring that at 5.4% versus 8.2. And another way to consider that is, when the market is up, how much of that do you capture? So we've captured 96% so far, again, very early days. But and more importantly, on the downside, we've only captured 65% of the downside. So these are some of the metrics we'll be reporting, again, trying to produce good returns, but also with much less downside volatility. In terms of attribution, stock selection so far has added around 240 basis points. A lot of that has come from industrials. MDA, Magellan, and Zedcor have been the biggest contributors. Materials had the biggest attraction. CCL, VNP, and G Mining were the biggest detractors of sector of stock selection. The fund is just over 12 million in assets and hopefully growing. That's the intent. We have 40 longs. We don't have any shorts currently. When the market is coming off a major turn, we don't want to short individual names because oftentimes the ones that are beaten down the most and not necessarily ranking well on our quants will rally the most. So currently we don't have any shorts. Our sector weightings are shown here in this chart. Financials, industrials, and tech are the biggest overweights. And I just wanted to touch on one other aspect. We have a very high active share. And what that means is that we're quite different than the TSX. We have a lot of exposure to small to mid cap stocks. 27 of the 40 longs are in that market cap bucket, representing 65% of the assets. And if a little last chart here to describe active share for people, if we think about this Venn diagram and the fund would be in red and the market in gray, our active share currently is 90%. The average fund's active share in Canada is 50%. So if the fund has nothing to do with the TSX index, that would be 100% active share. If it were mimicking the index entirely, that would be zero. So we're aiming for quite high active share. We think that's a big differentiator with exposure to small to mid cap stocks and significant sector bets as well. So I will leave it at that. And if anyone has any questions, our contact information is here. We'll be emailing these documents out with the video. So I'll leave it at that, David. Any comments from you? Or?
No, Mark, I think that was very comprehensive, and we're tremendously excited about taking an idea that has been percolating for a number of uh, years now, and
Mhm.
taking your expertise, working with our firm, and deploying it in the marketplace. So we're tremendously excited. We're off to a solid start, and we're looking for good good things over the next few years.
Mhm.
I always tell people to be mindful of investing over the long run because that's where volatility, shocks, or surprises are ultimately eliminated or dispersed. So yes, Mark, I think I speak for both of us when I say we're tremendously excited and we thank you very much for your support and interest.
Wonderful. So we'll leave it at that. Again, if anyone has any questions, feel free to reach out. My contact information is here, or David's is available as well.
Thank you.
Uh, Thanks a lot.